If you've been watching silver at all, what just happened in the last few hours should make you stop whatever you are redoing and pay attention. Because silver didn't just dip, it didn't just pull back. Silver collapsed 22% in under 2 hours. This was fast, violent, and highly coordinated. Silver went from near $90 to the low 70s almost overnight. Futures collapsed, and social media instantly filled with people saying, the silver story is over. Moves like this don't happen at random. Before we go any further, if you value clear explanations without hype, fear, or fake promises, make sure you like this video and subscribe to the channel with notifications on. To cut through the noise and help you understand what's really happening beneath the headlines, that support helps this channel survive. Now let's get one thing straight right away. This was not investors suddenly deciding silver is worthless. What we just witnessed was a leveraged system being forcefully unwound. And there is a massive difference between those two things. Silver was pushing into a zone that professional traders were watching very closely. The area between $87 and $90 was heavy resistance, not emotional resistance, not Twitter resistance, real technical resistance. Price tested it, stalled, tested again, failed again. Each daily close below that zone was a warning sign that pressure was building. When markets fail at resistance repeatedly, they snap. It started in Asia, on the Shanghai Futures Exchange. In a single session, an unbelievable amount of silver paper contracts changed hands. We're talking hundreds of millions of ounces worth of paper silver traded in hours. To put that into perspective, more paper silver traded in one morning than the world mines in an entire year. That alone tells you this was not physical selling. This was leverage. Something very different was happening quietly in the background. Physical silver was leaving vaults. Delivery notices were being issued and accepted at levels that are almost unheard of. Normally, only a tiny percentage of futures contracts ever result in physical delivery. Recently, nearly all of them have. Think about the contradiction for a moment. On the other side, real metal is being pulled out of the system as fast as possible. You can't explain that with fear. You can't explain that with a broken silver thesis. You can only explain it by understanding that paper and physical silver are no longer moving together. This is where most people get confused and make emotional decisions. They see the price collapse and assume demand must be gone. But the physical market is telling a completely different story. China is still paying a premium. Backwardation is appearing in places it normally doesn't. These are signals that don't show up on a Robinhood chart, so why crash the price so violently? When too many traders pile into one side of a trade using borrowed money, it hunts liquidity, and it transfers wealth from emotional traders to disciplined ones. No, and this part is important. If silver fails to hold the low 70s on a daily closing basis, $70 or even lower becomes a real possibility in the short term. That's not a prediction, it's a risk scenario. Deleveraging phases don't end on comfort. But here's what hasn't changed. Physical shortages haven't magically resolved themselves, and governments haven't suddenly stopped needing real metal for infrastructure. You can't build data centers, power grids, or military hardware with paper contracts. What we're watching is not the death of silver, a transition away from a paper-driven price discovery system toward one that increasingly reflects physical reality. That transition is messy, and it punishes anyone who confuses speculation with investment. Exchanges are raising margin requirements. When systems come under stress, intervention always follows. An intervention changes the rules of the game. These tools don't stabilize markets for speculators. And when that happens, paper traders are the first to be sacrificed. One of the most dangerous assumptions people make is believing they can always exit when they want. In a leveraged environment, that illusion disappears fast. Liquidity vanishes. Meanwhile, mainstream financial media is already mocking silver investors. They always do this at lows, never at tops. They ignore the fact that silver has massively outperformed many popular assets over the past year. They ignore the structural deficit, and they focus only on the crash. At Past and Profit, we don't chase hype, we look at structure. Violent sell-offs inside long-term bull markets are not a sign of failure. They reset positioning and set the stage for the next phase. That doesn't mean the next move is immediate, and it means understanding your time horizon matters more than ever. Traders chasing breakouts without a plan were punished today. Long-term holders focused on physical supply and demand saw something very different. So where do we go from here? First, whether silver can stabilize and hold support on a daily basis. Second, whether physical premiums expand or contract from here. And third, whether vault withdrawals and delivery behavior continue at these elevated levels. Those signals will tell us far more than headlines ever will. It shows who was gambling and who was prepared. And it reminds us that price is not the same thing as value. If you've stayed with me this far, drop a comment and let me know what you're watching next. Do you think silver tests lower levels? Share this video with one person who needs clarity instead of noise. We are watching a system adjust in real time, and where equilibrium finally settles are still open questions. Moves like this don't happen at the end of stories. They happen in the middle of them. Invest with logic, not emotion,